All right, let's bring in our first speaker now.
Why not?
Kei Chua, partner for special situations investment in Greater China and North Asia at Bain Capital. Kei, you've been sitting here for a while. Thank you so much for joining us and kicking off the credit forum here in Hong Kong. First of all, it's an interesting title that you have. Maybe you can introduce what special situations, what your coverage is.
Sure. Special situations, as Bain Capital defines it, really means flexibility. What we do is we create bespoke capital solutions that specifically target and address the needs of our counterparties. Meaning, we borrow in the capital structure, we borrow between terms and conditions that may be akin to debt, such as covenants, maturity profiles, governance structures, and then also try and structure for equity convexity. So if we're right, we get some upside. And what that means is that creates a really interesting risk-reward profile for Bain as well as the counterparty, because then they're actually getting specific capital targeted for the use that they need.
Right, and just to clarify as well, partly for our audience, this is mostly in private markets. Do you dabble as well in public markets?
We're pretty flexible. Bain Capital's special situations is Bain Capital's most flexible capital globally. So we can be in NPLs, we can be in private markets, we can be in public markets, and throughout Asia Pacific, we are investing as well.
And how busy have you been so far this year, Kei? I mean, given where we are in the credit cycle, and where are we in this credit cycle?
We've been quite busy. We think it's a really interesting time to invest in China, specifically, as well as in the rest of Asia. We don't have hard targets by countries, but because we're a pan-Asian platform, which means that we're allowed to ebb and flow between markets that we think are interesting. And we're still very focused on China. China is one of our core markets, as you mentioned. Right now, we think the economic situation in China is challenging, but it's understandable. When you have 20 plus years of above average growth, you're going to have some hiccups now and then. And because we are long-term players, because we believe in the capability of the government to actually work through some of the issues in the marketplace, we think that it's very attractive and that there will be a return to normalcy and stabilization in China in the near term.
Right, and at the center of that, speaking of special situations, the property market is in a special situation at the moment. Where do you think we are in that story?
Property is a really large term in China, right? It represents approximately 25% of GDP, maybe more. And the way we define it is there's very different asset classes. If you think about traditional property, residential, commercial, we're in an oversupply situation. We're in a situation where developers, frankly, have been investing heavily into land banks, buying land, and trying to grow them without the requisite demand in place. And that property model, we think, is broken. And that ultimately led to what we saw in the high-yield markets, because they've been borrowing heavily, a lot of times from offshore markets, and then using that to buy land banks because they were valued off of the number of years of land bank that they had, 8 years, 10 years, the more the better. And the flip side now, can they deliver on those properties? What we need to see is the execution of that. And that's why the government has been coming in to actually take projects off the land, sell off projects so that we can deliver those projects to the buyers locally.
And obviously, we talked about this downturn entering into this new phase where you're talking about wind-up orders. You're talking about liquidation possibly on the table as well. In some ways, I mean, are you thinking that this restructuring is a year-long effort? Is it going to take months, years? How is this all going to play out?
Yeah, the sheer scale of the problem is actually pretty large, and there is no quick fix. I think the government's afraid of its moral hazard by just restructuring the developer. And so the approach has been, how do we take individual projects, how do we find the projects that are attractive and work through those? And when you do that, it's execution. It takes a year to 2 years to build out a project, right? And so by going in and taking each of these projects, it's going to be a multi-year process.
And you've been investing in China for so long now. I'm just wondering, in this current cycle in the property market, I think early on you said you noticed signs of maybe something was about to go south. What were those canary in the mines for you?
Yeah, so our team, we've invested. Bain Capital has been in China for almost 20 years now, and so we have a large footprint on the ground. We have 3 offices in China, And our team is there every day with local networks. And what we saw was exactly the situation where developers were buying land, participating in auctions, reaching successive highs on a per square meter basis as they were buying things. And what we also saw was a lot of ghost towns. We saw a lot of property that was built where there was no demand. And if you look at the high-yield markets, the high-yield markets was dominated by Chinese property developers that was borrowing cheaply from overseas. And so we largely stayed away from that. We thought this is a leverage situation, and if there's a hiccup in execution, if there's a hiccup in refinancing, the Chinese local banks have set limits in terms of how they were going to finance these properties, so it became an offshore and an onshore market, onshore and offshore market. And therefore, we just thought this is not going to end well.
Okay. And what among those early warning signs you think either still exist in the market, or even if they do exist, where you have enough information to at least be actionable at this point in time?
I think the supply-demand situation is still a problem. It's not just in residential; it's also in office as well. Rents, we monitor rents in all the major cities. Rents have been declining as people have tried to fill the space. So you're seeing vacancy rates as well as rents still being soft, particularly compared to what we saw in 21 before the crisis happened.
I mean, the sticking point still remains that key hurdle, which is the physical market needs to turn around. When do you think that's going to bottom in some ways? And once it does, can credit markets bounce back?
Right, and does that solve the problem?
I don't know when it's going to bottom, but I do think that where we'll see it is as more and more of the projects get delivered and executed on. I mean, there's still a lot of buyers that haven't received their properties yet, people that have put deposits down, their life savings for several years. I think we need to see some movement in the restructurings of some of these developers, the 23 names. There's quite a few of them that have been in the process for over a year and a half. We need to see some satisfactory resolutions before foreign investors are willing to come back in and refinance high yield. We need to see some clarity and stability in the policies around property. I mean, the government's doing the right thing, but they're doing it in increments because, again, trying to avoid the moral hazard. I think that's going to be an important litmus test as to when the property market starts to come back.
That's a good point. I mean, timing this thing is incredibly difficult, if not impossible. And what are, not just yourself, players like yourself in the industry, what is sentiment like? What do you think people are watching very closely before they actually pull the trigger? And are we close to that point where you actually might see big transactions start to take place?
Yeah, luckily in the private space, and particularly with Bain Capital, where we have long-term capital, it's patient. We can wait. We don't have to be the first to run and take on the extra risk, right? In fact, I explained how we make our investments, right? We're actually very bespoke and tailored. I think the general market sentiment is that property has been a challenging sector. A lot of property funds and property corporates have actually pulled out of China, saying they're not going to invest further into it. We think that's short-sighted. Right, we want to be in China long term. We've invested in there. We have a lot of infrastructure and networks, and that allows us to keep our ear close to the ground. It may not be specifically the whole sector, but it could be interesting projects or interesting geographies. Right, real estate is about location, and that's how we are tackling the situation, trying to figure out specific sectors. And real estate, for example, outside of traditional real estate, we've actually been very active. We've been investing into the infrastructure that supports economic growth and domestic consumption, things like logistics, warehouses, manufacturing workshops, data centers. Those are growing at above average rates. Those are very stable. They're specialized, so you have locked-in tenants. And so there are different markets within real estate that we still find quite interesting. On the residential side, I think it's going to take some time because it's pretty commodity. And you need to have that long-term capital that's available before you can start to build these out.
I think we ended the last segment on just really what the key sectors still remain in terms of, so residential, that's still fairly iffy at the moment. Industrial might be somewhere you're looking. How much have you guys invested in China, special sits, for the last few years?
Special sits, we've invested almost $2 billion over the past 7-8 years. And then as Bain Capital in China, it's been over $5.5 billion since we entered almost 20 years ago.
Right, and sort of within special situations, $2 billion. What's the current? Where are your current interests right now?
So special situations, we're actually industry agnostic. But what we do like to do is identify sectors and opportunities in the marketplace. And historically, we've invested into non-performing loans, for example. But we've also invested into, as I said before, the infrastructure for domestic consumption. So logistics, warehousing space, manufacturing workshops. These are highly specialized assets that are needed to facilitate the flow of commerce in China.
And you're following the policy tailwinds in some ways, too.
We're following the policy tailwinds, and so we are avoiding certain sectors that have policy headwinds. But overall, we do like industrial. We do like consumption and consumer. And our team is constantly identifying interesting industries that have strong cash flows, that have stable cash flows and are growing, and also the ability for us to really structure. Because remember, we have the ability to be very bespoke. And so we can come in and structure payment in kind type securities. You can structure back-end dated equity convertibility. So companies that don't necessarily qualify for plain vanilla bank financing, we can come in and create something that really solves their problems and their needs. And particularly in the real estate space, that's actually required quite a bit of capital over the years. And in situations like this market where they don't have ready access to capital, it's a great opportunity for us to come in and create bespoke solutions for them and fill that gap in the market.
Right. I'll talk a little bit more about that because that's quite topical, as I guess in many ways the official push, or the push from officials is really to try and get the money where the money's needed, right? And there's quite a big gap between the official banking system where you are with shadow financing players like yourself. So yeah, what are you guys busy with and studying at the moment?
So we're actually pretty comfortable that the government has the right policies and execution capability to remedy the situation. So you just discussed the LPR. They have quite a bit of policy room in terms of cutting the LPR, cutting the reserve requirement ratios to create more liquidity in the system. However, there's never enough liquidity in China because they're trying to grow, and there's a lot of export-oriented business, a lot of capital needed. And so our ability to come in and really provide that capital at a much-needed juncture in the market is actually really strong. We made 2 new investments in Q4 in China, pretty substantial check sizes, and we continue to see interesting opportunities.
Okay. Do you want to talk more about that, or the check sizes or the transactions? Okay. No, okay. I'll skip. No, I was actually going to ask a follow-up on, you talked about the LPR, right? They've taken rates down substantially in China. And I'm wondering, from your perspective, has that brought down the cost of capital for clients enough, in your view?
Well, generally the people that we're dealing with are not doing standard secured loans, mortgages. And so it may be at 2-3%. But if you can get that capital, you're not going to be talking to someone like me, right? We're coming in and basically creating bespoke solutions for them. It's not necessarily going to be secured. Again, private credit is pretty broad. It could be senior secured direct lending, like mortgages and secured, or it could be mezzanine and sub-debt, or even convertible equity-linked type securities. Generally, we play in the latter half, where we are looking for more alternative investment type returns and the ability to actually create equity convexity when we're correct. And so those that can have access to standard senior secured lending aren't going to be, it's more of the investment grade side.
Yeah.
So do you expect deal flows to pick up? I mean, especially in the distressed asset space, too?
Yeah, deal flow is definitely picking up. In these types of markets, there's a lot of dislocation. There's a lot of distressed assets. There's a lot of mispriced assets. Non-performing loans or specifically assets with debt against them that need to be restructured and need capital to come in are pretty interesting for us. And if you have the local presence, the local team, the capability and the track record and long-term capital, you can create some really interesting risk-reward situations for yourself.
Sounds like it's expensive to be your client. No. So I was having a look at the high yield, the Bloomberg high yield index coming in. So we peaked at 32%. I think we're now closer to about 14%, which might be just about some of the rates you're alluding to there. I guess my question is, when you look at the offshore bond market, because a lot of that also has to do with sort of how things have frozen up in some ways here. How long do you think before the offshore bond space heals? Is that a good way to put it, or?
I think investors are looking for a few things, right? First of all, some more transparency in terms of what's going on in the real estate sector. We need to see some more restructurings taking place, coming to fruition. We need to see some more concrete data about economics, what's happening in the environment. We need some clarity in terms of government policies. Right? There's actually quite a bit of positive policy support, monetary, fiscal policy, but that's trickling in, right, because of that moral hazard question. And finally, we need to see some recovery in the capital markets. Right? The geopolitical situation isn't helping things because high-yield investors are generally from the Western world. Right? They've been burned. They've been burned when their Evergrande bonds go from 100 to 2 cents, 1.5 cents. I think people need to see those resolve themselves. Then they'll have more capital to deploy back into the marketplace. So I think it's a multi-year issue, multi-year solution. Right? The bonds that they invested into had weak, were structurally subordinated, had weak covenants, and I think we're going to have to see a reset of that if any new money comes back into the marketplace.